You're sitting at the kitchen table with a piece of paper in front of you. The loan officer said, yes. 480,000, monthly payment, $3,400 a month. And something in your stomach won't sit still. Not fear, exactly, something quieter, like the numbers are adding up to something you haven't finished adding yet. Here's what that feeling is. That $3,400 on the paper, that's not the cost of the house. That's the deposit on the cost of the house. And by the end of this, you're going to know the real number, the one the bank didn't show you. Here's the thing about that meeting with the loan officer. It felt like the decision, like you were the one being evaluated and you passed, and now it's your call whether to sign. That's how it's supposed to feel, but that's not what actually happened. The bank made its decision before you walked in. The approval letter is the bank telling you what it can still collect if things go sideways. That's the math it ran. The number it gave you, $3,400, is the number that works for the bank. Whether it works for your life is a completely different question, and it's the one nobody helped you answer. So the real decision hasn't happened yet. Your job right now isn't to decide whether to take the loan. Your job is to figure out what the real monthly number is, the one that determines what your life actually looks like for the next 10 years. That's the decision. And you're about to have everything you need to make it. Now I want to show you what happens when people don't run that number first. Because this isn't a hypothetical month 4 of ownership, the air conditioning dies, full replacement, we're talking several thousand out of pocket right now. But here's the problem. Closing costs ate the emergency fund. So it goes on a card, and now there's a card balance on top of everything else. Then the property tax reassessment hits. See, when you buy a house, the county updates what your home is worth for tax purposes. That's called reassessment. And the new number is the price you just paid. The previous owner was being taxed on an old, lower number. You're not. So the escrow account, the account the bank uses to collect your taxes and insurance inside your mortgage payment, comes up short, and the bank adjusts. The payment goes up without warning. In month 6, none of that is catastrophic on its own, but all of it lands on a household that's stretched to make the original $3,400 work. There's no margin left to absorb it. This is not foreclosure. Foreclosure is the dramatic version, the one that shows up on the news, the one nobody thinks will happen to them. This is the quiet version, and the quiet version is what actually happens to people. And here's what that actually sounds like, day to day. She starts routing every decision through the same sentence. Dinner out, but the mortgage. Trip to see her sister, but the mortgage. The work laptop she's been putting off for 2 years, but the mortgage. It becomes the answer to everything. Not because she can't afford those things exactly, but because there's nothing left. The house took it. She's fine on paper. Good credit, steady job, owns her home, right? She's tight in her body, she goes to sleep doing math. And I want to be clear, she's not stupid. She's not irresponsible. She didn't miss something obvious. She sat across from a professional with a title and a spreadsheet that a major institution trusts, and that professional gave her a number, and she used it. The problem isn't her judgment. The problem is that the number she was given was never designed to tell her what she could afford. It was designed to tell the bank what it could still collect. Those are not the same thing, and nobody told her that before she signed. So let's look at what's actually inside that $3,400 figure, and then let's look at what isn't. The number the bank quoted is called P&I, principal and interest. That's the loan part of your mortgage, the part that's just the money you borrowed and the interest on it. 2 letters. When most people say my mortgage payment, that's what they mean. That's what the loan officer wrote on the paper. That is not the cost of owning the house. Here's what gets added on top. Each one has a name people half understand and a number they've never actually seen until they're living inside it. Layer 1, property tax. According to Atom's 2025 analysis of property tax data, the national average effective tax rate, what you actually pay in property tax as a percentage of the home's value, is roughly 0.9% per year. On a $480,000 house, that's about $4,300 a year, which is $360 a month. That's the average. But, and this is the part that matters, here's what average is hiding. State rates go from 0.33% in Hawaii all the way up to 1.84% in Illinois. That's a spread of more than 5 to 1. The average is not your number. Depending on where you live, you could be at $130 a month or $735 a month on the same house price. Layer 2, homeowners insurance. Based on Insurify's 2026 projections, the average annual premium runs just over $3,000 a year. That's about $255 a month. And again, the average is doing a lot of work. If you're in Florida, you're looking at north of $8,000 a year. If you're in Hawaii, closer to $660. The range is wider than the average is useful. You need the quote for your actual address, not the national number. Layer 3, PMI, private mortgage insurance. This one only applies if you put down less than 20%. PMI is an extra monthly fee the bank tacks on when you put down less than 20%, basically an insurance policy for the lender in case you default. The rate varies enough that I'm not going to pin it to one number, but it's real money every month, and it doesn't go to your equity, it goes to the bank's protection. Layer 4, everything the bank doesn't escrow for. This is where the 1% rule lives, and where intuition fails hardest. If you've read any personal finance article in the last 15 years, you've seen it. Set aside 1% of your home's value per year for maintenance. $480,000 house, $4,800 a year, $400 a month. Easy to remember, tidy, and way too low. The National Association of Home Builders analyzed actual homeowner costs using the American Housing Survey real homes, real bills, real repair records. What they found is that total annual operating costs, maintenance, utilities, everything the bank doesn't collect in escrow run closer to 3% of the home's value per year for newer homes and 5% for older ones. That's not a maintenance-only figure. That's the full tab. Repairs, heating and cooling a bigger space, water heater, lawn, all of it. The stuff the bank leaves completely off the paper it hands you. On the same $480,000 house, 3% is $14,000. $400 a year, about $1,200 a month you need to plan for on top of your P&I, your taxes, and your insurance. We've all seen the 1% figure floating around like it's gospel. It's not. It's a cliche. The 1% rule would tell you $400. The real number is 3 times that. And the gap between the cliche and the data is where house poor comes from. For an older house, at 5%, you're looking at closer to $2,000 a month in operating costs beyond your mortgage, taxes, and insurance. Not because something is wrong with it, because that's what houses cost to run. Now let's add it up. On the $480,000 house with 10% down at current rates, P&I on the $432,000 loan, that's the LTV, loan to value, meaning how much of the house's price you're borrowing comes out to roughly $2,700 a month. Property tax at the national average, $360. Homeowners insurance, $255. PMI at a midpoint estimate, roughly $300. Operating costs beyond escrow at the 3% figure, $1,200. That's about $4,815 a month. The bank quoted $3,400. That's not the payment. That's the deposit on the payment. The gap is more than $1,400 a month, and some portion of it is at least visible in the bank's paperwork. Taxes and insurance do factor into the bank's DTI calculation, the debt-to-income ratio, which is the percentage of your pre-tax paycheck the bank expects you to spend on debts, including your mortgage. But DTI is the bank's risk threshold, not yours. Fannie Mae's automated underwriting will approve a conventional loan with nearly half of your gross income going to debts, half of gross, before taxes. That's the bank's definition of you can afford this. The bank isn't measuring whether you'll have a life, it's measuring whether you'll still pay. So the real problem isn't the mortgage, it's the number they never showed her. So here's what you actually do before you sign anything. Action 1. Build the real monthly number before you tour. This week, 30 minutes with a calculator. Before you fall in love with a house, before you make an offer, before you're emotionally committed, sit down and run the real carrying cost. The real monthly cost of owning the house with everything included. The formula is P&I plus property tax, use 1% of the price as a floor, and higher if your state runs higher. Look it up for your specific county plus homeowners insurance. $255 a month as a starting floor, higher if you're in a storm or wildfire state, plus PMI if you're putting down less than 20%, plus 3% of the home value divided by 12 for maintenance. Add those up. That's your real floor, not the P&I, not the quote, the carrying cost. If that number doesn't fit in your actual budget, not your approved amount, your real monthly take-home after taxes and existing obligations, the house doesn't fit. It doesn't matter what the bank approved you for. The bank approved the bank, you're approving yourself. And 30 minutes now saves you years of Sunday night math. Here's action 2. Run maintenance at 3% of home value annually, not 1%, and set it aside from day one with one automatic transfer. The month you get the keys, you open a separate account. Not your checking account, not your regular savings, a dedicated account labeled something like house fund or maintenance reserve. Every month, automatically, you deposit 3% of the purchase price divided by 12 into that account. You treat it the same way you treat rent. It is not optional. It is not for vacations. It exists for the moment the water heater goes, or the roof needs patching, or the HVAC needs a part. The 1% rule will tell you this is too much, right? The data will tell you the 1% rule is wrong. On a house from the 90s or earlier, 3% is still a conservative floor. The money you don't put in this account doesn't disappear. It just shows up later on a credit card at the worst possible time. Fund it from day one before you know what you need it for. Before closing, that's action 3. Call your county assessor and ask what your property tax will be after reassessment. One phone call. This is a call most buyers don't make, and it's the reason so many people get surprised by an escrow adjustment in month 6. When you buy a house, the county updates what your house is worth for tax purposes. That's the reassessment, and it uses the price you just paid as the new basis. The current owner's tax bill is based on whatever they paid years ago or whenever the county last reassessed them. That number is almost certainly lower than yours will be. Call the assessor's office in your county before you close. Ask them directly, based on a purchase price of X, what will my annual property tax be? Get it in writing if you can. If they won't give you a hard number, ask how they calculate reassessment on a sale and do the math yourself. You want this number before closing, not 6 months after. When the escrow account adjusts and the payment jumps, nothing went wrong. You just didn't have the right number. Now you will. Action 4, shop insurance in your specific zip code with 3 real carriers before you go under contract, before your offer, one afternoon. Not a rough estimate from the loan officer's preferred vendor, not the national average from an article, real quotes on the actual address. Different carriers price the same house very differently based on the age of the roof, the proximity to a fire station, the construction type, the claims history in that zip code. In some states, Florida especially, also parts of California and the Gulf Coast, the insurance quote is not a detail, it is a deciding factor. A house that works at $255 a month in insurance doesn't work at $700 a month. You need to know which situation you're in before you're under contract and in love. 3 quotes, real address before you make the offer. If you're in a high-risk state, do this first before you even start touring seriously. The quote will tell you whether the math works at all. If the real monthly is already sitting at 35% or more of your take-home, one shock breaks the budget, so action 5 is to stress test it now. This week, 20 minutes with your actual budget open. Take the real monthly number you built in action 1. Now write down what happens if one thing goes wrong. Your household loses one income for 3 months, the roof needs repair, daycare rates go up 15%. Your car needs a major fix. Pick the one that's most likely in your situation and run it out. That's not the catastrophic version. That's the quiet version, the we can't go out anymore version. The we're not fighting about money, but we're always thinking about it version. If you run 2 possible shocks and you'd still be okay, the number works. If one shock already does damage, the house is asking you to give up your margin. You get to decide if that's worth it. But you should decide it consciously, not discover it in month 4. And here's the one most people skip, action 6. Compare total monthly owning to total monthly renting for the same size and area before you decide to buy it all. 30 minutes with a spreadsheet. Not mortgage versus rent, Real monthly versus rent. Take the full carrying cost, the number from Action 1, and compare it to what you'd pay to rent a comparable place in the same area. Add the utility delta to the owning side. Look at what you'd need to invest the down payment to generate returns elsewhere if you want to get detailed about it. Sometimes the real monthly is still better than renting. Sometimes it isn't. The answer depends entirely on your market, your timeline, and your situation. The point is, renting is throwing money away is not an analysis, it's a phrase. You can't know what the right move is until you run the actual numbers on both sides in your specific zip code. Sometimes buying wins by a mile, sometimes it doesn't make sense yet. The spreadsheet will tell you which, the phrase won't. Let's go back to the kitchen table. Same paper, same approval letter, $480,000 monthly payment listed at $3,400, but this time, before she does anything else, she runs the formula. She starts with P&I. 10% down means she's financing $432,000, that's the LTV, 90% of the purchase price. At current rates, that comes out to roughly $2,700 a month. That's the number on the paper, close enough. She calls her county assessor before closing Action 3. Her state's effective tax rate runs 1.3%. On $480,000, that's $6,240 a year, $520 a month. She uses $520. She pulls 3 real insurance quotes on the specific address Action 4. The best quote comes back at $2,900 a year. That's $240 a month. She uses $240 PMI. She's putting 10% down and her credit is strong, so she's at the lower end of the range. She estimates $250 a month. Operating costs beyond escrow. The house was built in 2004. Not brand new, not old. She uses the 3% figure for everything the bank doesn't collect, repairs, utilities above her old apartment level, all of it. $14,400 a year, $1,200 a month. She opens a separate account the day she gets the keys and sets up an automatic transfer. It doesn't touch her checking. It goes straight to the house fund. Her real monthly, $2,700 plus $5, $20 plus $2, $40 plus $2, $50 plus $1,200. That's $4,910 a month. The bank said $3,400. The real number is $4,910. The gap is over $500 a month, and the house fund hasn't paid for a single repair yet. That's not a rounding error. That's the number that determines whether she goes to dinner, takes the trip, replaces the laptop. The bank didn't show it to her. Now she has it. Now, here's what matters. She doesn't necessarily say no. Maybe she says yes at this price because she ran the number and it fits tight, but it fits, and she stress tested it and it holds. Maybe she says yes at a lower price point, one where the real monthly lands somewhere she can breathe. Maybe she goes back and waits another year, saves more toward 20% so the PMI drops off. Maybe she rents the comparable place and invests the difference. This doesn't make that call. She does, but she makes it with the real number in front of her, not the deposit on it. So the right move isn't to take the bank's number and plan around it. It's to build your own number before you fall in love with anything. The bank wasn't telling you what you could afford. It was telling you what it could still collect. Run the real monthly. Before the next house you tour, sit down with that formula and build the full carrying cost, not the P&I, not the quote, the actual number with taxes and insurance and maintenance all in it. Then decide. With your eyes open, that paper on the kitchen table has one number on it. You're going to put a second one right next to it, the one the bank didn't show you. That's the number you make decisions from.